Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Richard Kellam, and the CFO, James Lorimer, from Data Communications Management. Data Communications Management trades on the TSX exchange under the symbol DCM, and it also trades on the OTC under DCMDF. The company is currently trading at $2.53 with about 44 million shares outstanding, or about $112 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Great to have Richard and James back with us to more or less update us on a pretty significant acquisition the company's made. You guys have made a lot of progress outside of just this acquisition as well. So happy to have you guys here. Happy to get the opportunity to really get updated. I'm just going to hand it over to you, let you guys do your presentation, and we'll follow up with some questions.
Okay, thanks, Paul, and welcome to everybody on the line. Good afternoon, and you'll hear me say this many times when I introduce teams. Good afternoon, good morning, good evening, because I don't know what time zones you're in. I actually lived about 18 years international, so it was important for me to make sure I was managing across time zones. Here's what we want to do today. I want to talk a little bit about, for anybody that's new to the DCM story, a little about who we are, where we're going from a strategic perspective, how we're performing, some recent results, 2022 results, which we announced about 4 weeks ago. And then I'll lean in a little harder to the recently announced RD Canada acquisition. Okay. First of all, a little bit about myself, and I'll get James to introduce himself in a minute as well. I joined the company exactly 2 years ago, and I joined after a 38-year career in the consumer goods space. Longest run of my career actually worked for Mars Incorporated. Ran a bunch of different business units, ran their Canadian confectionery business, ran their business out in the UK, ran their European business, and also was the chief customer officer globally for Mars. So a lot of experience on the consumer packaged goods side, running different business units in different countries. Joined, as I said, DCM a couple of years ago after consulting with them or for them for about 4 months, and saw a fantastic opportunity. Obviously, the board was pleased with the consulting and offered me this gig. So, and then we'll talk about performance and what we've done since joining a couple of years ago. So that's a little bit about me. And James?
Yeah, hi, I'm James Lorimer. I'm the CFO. I've been with DCM now for almost 8 years. My background prior to joining DCM was in the capital markets. I was an investment banker with a number of small cap focused investment banks. A lot of experience, raising money and in mergers and acquisitions. And was doing some work with a small family office that ultimately made an investment in DCM back in 2014. And I had the good fortune to join the company in 2015.
And just for all shareholders that are on the line, or potential shareholders, I have a lot of operational experience, but I'm really a growth guy, kind of sales and marketing guy, and have been for my entire career. So I live, breathe, and dream growth. And you'll see that as we go through the deck here as well. But I also have a lot of experience in acquisitions and post-merger integration. A lot of the growth that was generated through my prior life came from acquisitions, well, both organic as well as acquisition growth. So lots of experience there, and I think we're well set when we talk about the Donnelly, the status of where we are with Donnelly. So a little quick spin on DCM. James, I'm going to ask you to flip to the next slide in the interest of time. Just go to one slide forward. So what we do at DCM is we help leading brands or large enterprise organizations manage their offline and online communication needs. So think of us as being best in class at communication execution. Work with 70 of the largest corporations in Canada, 3 of the 5 largest government agencies. We've been around for 65 years, and our revenue is just north of 270 million. So we're a very sizable player in the communication space here in Canada. We've got operations across Canada. When I say operations, these are mostly physical print locations. So where we're converting communication into physical print. I'll talk a little bit more detail on that in a minute. And our clients we've got a lot of diversity between our client base. We don't have a single client that is more than 8 or 9% of revenue. We work across 8 key verticals. We actually, work in 9 or 10 verticals, but 8 key verticals. And you can see this on this slide in transportation, financial, healthcare, retail, emerging markets, et cetera. Our largest vertical is financial, and we're supporting a lot of the workflow and communication needs for all the tier 1 banks in Canada. But you can see a lot of diversification, which actually positions us well in the market. Okay. Our strategic direction is very clear. We want to build a better and bigger business, and I'll talk that in a little bit more detail how we're performing against that. Strategy is to, James, the next slide. Strategy is to move from what we call a print first company. And I want to be clear here to shareholders. We're not suggesting we're going to get out of print. We actually love print. We've mapped all the margin pools. We understand exactly where to play and how to play. But we want to enable that print with technology. And I'll talk a little bit more detail on that in a minute. So think of workflow optimization using technology that may end up in a physical printed product. So that's kind of what we do, and we're best in class at. We actually put a 5-year plan to the street about 6 months after I joined that said we saw a path to between 5 and 10% revenue growth, 35 to 40% margins. We are operating and will continue to operate at zero overhead growth. So getting into that 18 to 20% SG&A range, which should obviously spin out a pretty positive EBITDA. And our commitment to debt would be leverage, kind of well less than 1 times. I think important to note on this slide as well, we're not going to get into a lot of details in this call today, but happy to take any follow-up. Our commitment to really accelerate our MarTech solutions, so kind of pure SaaS platforms. And those margins obviously are considerably higher than the 35 to 40. They're kind of north of 80% range. Okay. So print first, the digital first with some MarTech solutions underpinning that. Go to the next one. Again, not going to unpack this on the call, but we've got on the far left of the slide, we've got a platform we started building this thing about 15 years ago. I'd say really accelerated the last 10. I really got focused on the last 2, which is DCM Flex. That's our workflow optimization program. So that helps large financial institutions, large retailers, large transportation companies, energy companies, et cetera, optimize their workflow, that kind of physical or virtual workflow with technology. Okay. So it takes a lot of waste out of the workflow, and we win a lot of business by starting with technology and maybe, using it to deliver a physical product. And the only other reference point I'll have on this chart, we've got a lot of MarTech solutions that we're standing up actively. The one in particular that I'll reference in this chart is the Assemble platform, ASMBL. And that is a pure SaaS play for us in the digital asset management market, the MarTech market of digital asset management. That market is already north of a $6 billion market globally. And we are in the process of just completing our software development to be able to play into that market. That market is growing at north of 30%. And for shareholders on the line, think of it as a replacement for SharePoint, right? SharePoint has limitations, especially when you get into large, kind of massive number of assets are being created by large enterprises today. They just need a better way to manage them. And that's how this whole category has been created. So we're actually really excited about that. We're going to talk a lot about, kind of print and this acquisition, but we're really excited about our DCM digital group and our Flex optimization platform and the other kind of pure MarTech solutions we're bringing to market. Okay. So key part of our strategy, how are we performing? And I'll unpack this pretty quickly. Had a fantastic year. Remember I said that we saw a path to 5 to 10% growth. We actually grew at 16.3%. So we added close to $40 million to our top line on the year. And you can see we had consistent growth by quarter. So it wasn't just a one and done, 11% growth in quarter 1. And you can see the growth quarter 2, 3, and 4. We exited 20% in quarter 4. So very positive momentum. It's come from a combination of the new sort of growth muscle we've built, a little bit of a benefit from pricing, or we had some raw material headwinds in the marketplace. We had to price those increases obviously into our product, So we got some benefit there. But that's not easy to do, as you know, right? You can get hit pretty hard when you have raw material increases, but we certainly did very well. So a combination of price, mix, and volume is what delivered this growth for us. So a nice kind of mix across those three drivers. So consistent growth. Great to report as well, especially in a pretty volatile raw material market. Our gross profit actually grew faster than our revenue. So revenue at 16 and change, and gross profit at 21 and change. That means we're improving our margin, and you can see that on this chart. Our margin is 30.8% of revenue. So you can see we're well on our way to get into that 35 to 40% window. And that, again, it was a 5-year time horizon. Okay. And gross profit momentum continued across every quarter. In fact, three of the four quarters, our gross profit grew much faster than revenue. Okay, so quarter one revenue was 11.2. We were 8.2 on gross profit. You can see every quarter since then was well above. So great momentum on profit, which obviously, go to the next slide, James, is delivering. So there's a quick look. I wanted to put our 30.8 in perspective. Won't get into detail, but you can see how we've grown gross profit from 2016, which was 22.7%, up to 30.8. So done a very nice job sort of improving mix, driving operational efficiencies, understanding where the high margin pools are in this category and playing to those margin pools, and lots of opportunities for further margin growth. And certainly I've got experience in my prior life here. So that's certainly playing out well for us. And clearly, when we talk about the acquisition, we'll apply that to the acquisition as well. Net income very solid. James, you can go to the next slide. And obviously spinning out a very positive EBITDA up over 45% over a year ago. And we're at 13.3% of revenue. So you can see we're on that glide path to 18. And then you can see that our EBITDA performance was consistent across each quarter as well. So every quarter was well above a year ago. Okay. I don't think I'll go through the detail here. It'll be in the final deck that goes up on the web, so you guys can look at it in detail. Another thing we're very proud of is some of the efforts to build a better business. In particular, the debt reduction. You can see from a high of about 79.8 in the 5-year time horizon down to 27.3. So very good focus on debt reduction, 26% down versus a year ago, and about 66% down versus 2019. And a small point we put on this chart, it's actually the lowest debt we've had since our IPO. So a lot of kind of focus on building a better business, reducing debt, and a lot of focus on building a better business from, we call it building a growth muscle, and a big focus on new business development. And you can see in this chart, we actually added $35 million worth of growth to our business and about 35 new logos. And these are logos that have a lot of opportunities to, we call land and expand. So lots of opportunities for expansion revenue over time. Okay. And you'll see that growth muscle continue in our business as we move forward. And also, we're proud of what we've done in terms of headcount improvements and productivity improvements. A lot of this work was done before I entered, which was great. So I could actually focus on strategy and client leadership models and delivering our growth agenda. So some improvement, obviously. We're operating at zero overhead growth, operating at ZOG, 910 associates. And you can see what that means in this chart in terms of revenue per associate. We actually put a plan in place to cross 300 in 2 years, and we crossed that in year one of our glide path, our journey plan. So big improvement in productivity per associate. Okay. And again, also really proud of what we've done in terms of defining our ESG strategy and then targets. We've got clear targets around waste reduction, sustainability, carbon footprint, and renewable energy. And I think the one we're most proud of is we entered into a program with a company called Print Relief just over a year ago. And essentially 100% of our paper use is reforested for clients. So we used 58 million pounds of paper in our workflow last year. We put 702,000 trees back in the ground. And all of those credits flow through to clients that want to take credit for it. And we have actually won business, retained business, and built great relationships with our client as a result of this this print relief effort. And this is we have exclusivity in the Canadian market for this for a period of time. So real proud of a lot of stuff we're doing in ESG, but especially our reforestation effort. Okay. So that's a little bit about who we are at DCM, what our strategy is, how we're performing, and now we'll talk about the acquisition. I want to give you a little bit of background on the acquisition first. R.R. Donnelly Canada is part of R.R. Donnelly globally, and R.R. Donnelly globally is north of a $4 billion business. R.R. Donnelly globally used to trade on the New York Stock Exchange up until a year ago. A year ago, they were taken off the board by a private equity firm called Chatham Asset Management. So Chatham acquired R.R. Donnelly globally. And a little while after that transaction was completed, we started to have conversations with the R.R. Donnelly corporate team about the potential to acquire the Canadian business. So those conversations turned into where we are today, where we put a definitive agreement in place, made an offer, put a definitive agreement in place. This deal required clearance from the Competitive Bureau of Canada, which we cleared last Monday. So we are now working to close, and the plan is to close by, within the next few weeks, right, by the end of the month. So very good progress in terms of getting to as to where we are today. Go to the next slide. So this is a very complementary business to our business. This is just hit the next one. This is a play. What we say is a play for a strategic buyer versus a private equity firm. The only way private equity would go after a business like this is if they bought both businesses. Okay, so this is a perfect strategic play. We know exactly what we're buying. We know exactly what Donnelly does, what all their capabilities are, and their similar capabilities to ours. We have a good complementary client list. There's very little crossover in clients, and where there is crossover, we're actually bringing some different technology to those clients. There's a good operational footprint across Canada, and we've got a good associate base. So there's clearly some opportunities for integration over time. I think we're well planned. We've been using Boston Consulting Group, who I've used in several deals in the past, to get us prepared for post-merger integration. And we're all set for day one. So I'm not going to say much more there. I'll maybe wait for questions around this. The deal itself, I'm sure that most shareholders read about the deal and understood it, but I want to just kind of sort of unpack it a little bit. The deal is a $123 million deal, but think of it as $93 million for the business and $30 million for real estate that comes with the business. Okay. On the 93 million, it's roughly 4.5 times EBITDA. That's the multiple that we paid. And on the 30 million, those three facilities, the plan will be to sell and lease back, and we're already making progress down that road. Okay. The 123 million purchase price, obviously, is subject to working capital, but it will be fully financed. We've got Fiera Capital for that debt, and we've got a large chartered bank that we've got great partnership with over time. Our leverage on 123 plus our existing debt is 3.25, but the way to look at it is that 30 on real estate will be gone very quickly after close. So it brings our leverage down to about 2.6, 2.7. And then obviously we'll work to deleverage as we work, integration and synergy. So it's a great deal, fully financed, very complementary to our business, allows us to continue on this journey of building both a better and bigger business. Also allows us to apply the playbook that we've developed here at DCM, especially over the last couple of years, and bring that into the new co and be a bigger and better business together. So I don't think we need to get into this. We'll leave it up. In terms of the benefits, it's very clear that these two companies have complementary operating models, as I said, and there's some clearly some meaningful benefits to our clients and customers. Okay. and we'll just close on, summary, maybe summary, and then we'll turn over to Q&A is, look, we've been very focused on this journey over the last couple of years, building a better and a bigger business and really delivering momentum. And you can see that in our numbers, our momentum, solid momentum through 2022, which kind of started in the second half of 2021. And on the better side, we've worked hard on productivity, efficiency. What I haven't shared in this deck, we've done a lot of work on engagement, associate engagement, as well as client engagement. We actually audit that through a survey, and we've had huge improvements. Proud of what we've done in ESG, and then obviously debt reduction. And the bigger side, growing revenue, growing gross profit, growing profitability, building that new business muscle. And then, we're really happy with the pace we're on our acceleration to digital. So we certainly have momentum in our business, and it was a perfect time to do the deal that we announced, and we're excited to get to close. All right, so that's the end of the deck, and we'll turn it over to any questions.
Perfect. Well, thank you, Richard. I want to remind everybody, if you've got a question for me, just use the chat function, and I'll ask the gentleman here for some answers. So clearly the RO Donnelly acquisition, big step for you guys. Is this like a one and done? Is there any other M&A opportunities for you, or is this a big one you got to swallow before you sort of look again at taking something else on?
Yeah, so great question. We can certainly see a path over the next 5 years to get this business to $1 billion. We see a path on the organic side, in this kind of 750 to 800 range, just by delivering organic growth in that 5 to 10 range. So clearly, at some point, we'll be looking for some other strategic opportunities, acquisitions, more kind of tuck-ins. We think that this is a great play. Give us quite a complementary business for us. We'll be focused the next couple of years on just building a better business, really, driving hard on integration. But you'll see some more opportunities over time once we get this digested, if you will, integrated, and continue to, without obviously sacrificing any client, the client experience. So, yeah, we definitely see more opportunities for some consolidation in the market.
Mm-hmm. Now, you've done a spectacular job sort of tightening the operational effectiveness of your existing business. Do you see that opportunity here, or like what's the status of our Donnelly, as far as how it compares to your effectiveness or efficiencies?
Yeah, James, you want to comment on that?
Yeah, sure. We haven't given, kind of public guidance in terms of the kind of profitability of their business, but the parent company had gross margins in and around the 20% range. They still file their statements quarterly. The Canadian business is not dissimilar from that. The chart that Richard showed earlier, where our gross margins grew from the low 20s into the kind of 31% range over the past 6 years. We think that there's opportunities to continue to expand their margins in Canada.
Mm-hmm. Perfect. And then as far as a closing date, do you have a target for when you expect the deal to clease?
Yeah, by end of the month.
By end of this month. Okay, fantastic.
Yeah, so we were very successful getting through Competition Bureau, and so we cleared that quickly, and we're working to close now.
Fantastic.
Yeah.
Just generally, there's so much commentary right now around the economy and things slowing down, higher interest rates. What do you see as far as, say, the next couple of years, just in general? What does your business look like?
Yeah, so a couple of things. One is it's a large market to begin with, right? Just the physical printing market in Canada is a $10 billion market. Will be $525 million of a $10 billion market. So we see huge opportunities for us to grow our business in the existing environment, but really understanding, and we've done a great job kind of mapping the margin pools or the profit pools and really playing to those high margin pools. So lots of growth to be had in the market, even if the market got some headwinds. The other interesting thing or important thing to note is that we're a company that actually helps large organizations simplify their complexity. We like to say we eat complexity for breakfast. So the more complex a client is, the more complex an enterprise organization is, the more value we can bring to that client. We can actually help them do more with less, right? We can help them expand their marketing budgets, their marketing efficiency and effectiveness, right? And we've proven that out. We've proven that out with major banks and major clients across Canada. So as you know, if clients are looking to cut budgets or cut marketing workflow, we're the perfect place to go to help them do more with less, right? Move some of their budgets into our world, and we can help them, simplify that complexity, automate process, deliver more efficiency and more effectiveness across their network. So we've actually picked up a lot of business when, kind of markets go sideways. So
yeah. Is there a lot of smaller players, like small mom and pop operations? I imagine there are that you're competing with.
Yeah, you've got the largest in Canada would be Transcontinental, and I'm sure a lot of shareholders know who they are. And then you've got us and our Donnelly. And then you've got some players that are in kind of the 150 million range. And then there's a lot out there in the 25, a lot of and what we call commercial print and trade printers are in that 10, 15, 20, $25 million revenue range. So yeah, it's certainly a fragmented market, which is good for us, right? Because lots of opportunities to be able to create value. But what we do is a little different than some of the other smaller guys, because we're well embedded into enterprise, working across multiple lines of business and supporting that workflow across those multiple lines of business. So we generally play our strength, as I said earlier, is where there's a ton of complexity is where we play, and that's what we love, and that's where we deliver value. Some of the smaller guys wouldn't have the capabilities to do that.
Gotcha. And what do you see as the biggest challenges you're facing right now?
James, you want to answer that?
Yeah, we certainly experienced some inflationary headwinds, particularly related to paper price increases last year. And we saw some pretty aggressive increases in the cost of paper. That seems to be, we also had some significant supply challenges. It was just tough to get, the right stock or the right raw material. So we did boost our inventory up throughout last year in order to meet our increased demand. We're seeing that market moderate. We're not seeing price decreases yet, but we still expect some additional price increases through the year, but we think it's going to be a lot more moderate. And we're also seeing the availability of product become a little bit more predictable. Still have kind of pockets where some particular paper substrate might be difficult, but we're seeing that improve. So we've had good success in passing our price increases on to our clients. We were a little bit challenged in some of those instances last year, but we're continuing to do that this year for contracts that were a little bit more challenged, a little bit more difficult to pass those increases on immediately. So we're getting the benefit of that now.
Gotcha.
And that's one thing I'm actually proud of with our entire team. Supply chain disruption, I mean, it affected every industry, but dramatically affected the paper industry as a lot of paper mills converted to corrugate to be able to meet the needs of the Amazons of the world, right? The online world. And they're slowly converting those assets back. But we used to get paper inventory into our facilities either the morning of or the day before we ran, we had to run a client's work. And we got to the point where we needed to actually go out 3 months or 4 months and load up inventory to meet, just to meet the client needs and to meet our growth agenda. Obviously affected our working capital. So yeah, that was the biggest challenge. But you know what? We had an incredible team to help us manage through that. Our purchasing guys and our procurement guys, purchasing guys, supply chain guys have been fantastic. And there's no way we could have delivered that 16% growth without a team, this excellent team. And the other important thing as well, as you saw the numbers, gross margin grew faster than revenue. So we were very intentional about making sure we're recouping pricing in the marketplace.
Yeah, fantastic. I've got a question in from somebody that asks about the 30 million in real estate you're getting from our Donnelly. Do you envision sort of getting rid of any of that real estate, like shutting down any of the facilities there, or is this all? Do you need it all?
Yeah, you know what? I think that's a good question. We're still working the plan right now. We have some ideas in terms of where we're looking at opportunities for consolidation. Of those 3 facilities, one of them we already have a deal on, and shortly after close, we'll be announcing that deal. And the other two, we're determining and deciding, where they fit in the network over time.
Gotcha. Perfect. Okay, as investors sort of watching you guys closely now, where do you see sort of what are the metrics or maybe catalysts that we should really be paying attention, sort of over the course of, say, next 6 to 12 months to guide us that you guys are still on plan here?
Yeah, so a couple of key metrics, right? As I said, there's kind of 4 areas of opportunity for us: organizational synergies, operational, organization, procurement, and growth synergies. So stay focused on, what we're going to deliver on the growth side, because this is an opportunity for us to build a bigger business, not just a smaller business that's better. So we're leaning in hard to make sure that we're driving a collaborative environment across our organization, even while we work to physically integrate. So that's a key one. Watch the growth number. Obviously, watch the performance number on building a better business as well. Obviously, it's going to take time to align the organization and drive, kind of operational efficiencies, but they're key. It's key to us in this deal. We're very well prepared. And I think I mentioned earlier, we're using Boston Consulting Group to help us prepare for post-merger execution. So we will certainly be executing this with excellence. And as we unpack our quarters, as we present our quarters, we'll be talking about progress we're making, right? But we're as said, watch the performance on the top line, the middle line, and the bottom line, all the key lines, and that's what we're committed to. Yeah.
Gotcha. Perfect. Listen, that sort of wraps it up. I'm just wondering if there's any key message or key takeaway you want to make sure everybody walks away with today.
No, I guess the key message is, we certainly have proven over the last couple of years that we can build both a better and bigger business. The timing is perfect for us to undertake this acquisition. The market is ready for it. We're ready for it. Importantly, we're ready for it, and the market's ready for it. Very positive feedback from our client base, and we're just excited about getting started, executing with excellence, and building a better and a bigger business together. So look forward to the journey.
Fantastic.
Okay.
Fantastic. Well, thanks, guys. We've been speaking with CEO Richard Kellam and CFO James Lorimer, Data Communication Management, DCM on the TSX. Guys, I want to really thank you guys for joining us today, and congratulations on a fantastic last year and great looking acquisition.
Thank you
Thanks very much, Paul.
Thanks, Paul. Appreciate it. Thanks for the time.
You bet. Bye for now.